Have you ever wondered how to start building wealth in 2024? Well, investing is the answer you've been looking for. It's a powerful tool that can help you grow your money and secure your financial future. The key here is to start early. The sooner you begin, the more time your money has to grow. Now let's talk about the potential of investing. With the right strategies, it's possible to build a substantial nest egg. Think of it as planting a seed. It might not seem like much at first, but given time and the right conditions, it can grow into a mighty tree. In this video, we'll provide a step-by-step guide to help you get started with investing. We'll cover everything from understanding the basics and setting investment goals to developing an investment strategy and choosing the right platform. So, are you ready to take your first step towards wealth building? Buckle up and let's dive right in. Before you jump into investing, understand the basics. Let's start by defining some key investing terms. Stocks represent ownership in a company. When you purchase a stock, you're buying a small piece of that company, becoming a shareholder. You profit when the company's value rises and your investment grows with it. Bonds, on the other hand, are a bit like IOUs. When you buy a bond, you're essentially lending money to a corporation or government. In return, they promise to pay you back with interest after a specified period. Mutual funds are a pool of funds collected from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're managed by professionals and are a great way to get started with investing due to their broad exposure and relatively lower risk. Exchange-traded funds, or ETFs, are similar to mutual funds, but trade on an exchange like individual stocks. This means they offer the diversification benefits of mutual funds with the added flexibility of being bought and sold throughout the trading day. Now, let's talk about diversification. It's the practice of spreading your investments across various types of assets to reduce risk. Think of it as not putting all your eggs in one basket. If one investment performs poorly, others may perform well, balancing out your overall returns. This brings us to the concept of risk and reward. In investing, risk refers to the possibility of your investment decreasing in value. Reward, on the other hand, is the potential for your investment to grow. Generally, higher risk investments have the potential for higher rewards, but also higher losses. It's important to find a balance that suits your comfort level and financial goals. With these basics under your belt, you're now ready to move on to the next stage, setting your investing goals. Now, what do you want to achieve with your investments? Imagine this. You're embarking on a journey but have no destination in mind. Sounds a bit aimless, doesn't it? The same logic applies to investing. Without clear, realistic goals, you're essentially wandering in the financial wilderness. So let's talk about investment goals. These are the financial targets you set to achieve over a specific period. They fall into three categories: short-term, mid-term, and long-term goals. Short-term goals, think of things you aim to achieve in the next 1 to 3 years. Perhaps you're saving for a vacation or to buy a new car. Mid-term goals are slightly further out, usually within 4 to 10 years. You could be saving for a down payment on a house or your child's college tuition. Lastly, long-term goals span over 10 years and could include retirement savings or building a fortune. Once you've set your goals, you're ready to start crafting your investment strategy. With your goals in mind, it's time to develop your investment strategy. This isn't just about picking stocks and hoping for the best, it's about creating a plan that aligns with your goals and your risk tolerance. First, ask yourself, what am I comfortable with? This is about understanding your risk tolerance. Are you someone who can sleep at night knowing your investments might swing wildly in value? Or do you prefer a more steady and predictable growth? Your answer will guide the types of investments you'll lean into. Higher risk often comes with the potential for higher returns, but also greater losses. On the other hand, lower risk investments may not make you a billionaire overnight, but they can provide a steady and more predictable return. Once you've identified your risk tolerance, it's time to consider diversification. This is the practice of spreading your investments across different types of assets to reduce risk. It's like that old saying, don't put all your eggs in one basket. If one investment performs poorly, you have others that may be doing well to balance things out. This leads us to asset allocation. This is essentially how you divide your investments among different types of assets like stocks, bonds, and cash. Your asset allocation should reflect your risk tolerance and investment goals. For example, if you're younger and have a high risk tolerance, you might have a higher percentage of your portfolio in stocks. But if you're nearing retirement and need more stability, you might lean more towards bonds and cash. Remember, your investment strategy isn't set in stone. It should be flexible and adjust as your life changes. Regularly review your strategy to ensure it still aligns with your goals and risk tolerance. And finally, consider seeking advice from a financial advisor. They can provide personalized guidance based on your unique situation. But remember, it's your money, and ultimately the decisions are yours. With your strategy in place, you're now ready to start investing. With patience and diligence, you're on your way to building wealth in 2024. Your future self will thank you. Now, where exactly should you invest your money? In the digital age, there's no shortage of platforms where you can grow your wealth. Let's talk about three major types: online brokerages, robo-advisors, and traditional brokers. Online brokerages are like the supermarket of the investing world. They offer a wide variety of investment options at your fingertips, but it's up to you to choose what to buy. It's a great option if you like having full control and don't mind doing the homework. Robo-advisors, on the other hand, are more like a personal chef. They prepare your investment menu based on your preferences and risk tolerance. It's a more hands-off approach, perfect if you prefer automation and simplicity. Lastly, traditional brokers are akin to a private banker. They offer personalized advice and services, but often at a higher cost. It's a good option if you prefer a more personal touch and don't mind paying for it. Choosing the right platform is a critical step in your investing journey. Investing isn't a one-time thing, it's a journey that requires regular contributions and patience. Imagine you're climbing a mountain. You don't reach the top in a single bound, do you? No, you take one step after another, steadily and consistently. Investing is much like that. It's not about making one large lump sum investment and expecting immediate returns. Rather, it's about making consistent, regular investments over time. This strategy is often referred to as dollar cost averaging. Now, what does dollar cost averaging mean? It's a method where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. This way you buy more shares when prices are low, and fewer shares when prices are high. It's a strategic approach that can help mitigate the risk associated with market fluctuations. But here's the thing, even with regular investments, you won't see significant growth overnight. That's where patience comes in. Think about it, a tree doesn't grow in a day, right? It takes years and years for a tiny seed to grow into a towering tree. Similarly, your investments need time to grow. The magic of compounding works best over long periods. You see, when you invest, your money earns returns. Then those returns earn their own returns. This is compounding your earnings earning earnings. Over time, this snowball effect can lead to substantial growth in your investment, but it requires time. And that's why patience is so crucial in investing. It's tempting to get impatient when you don't see immediate growth. But remember, investing isn't about getting rich quick. It's about building wealth over time. It's about staying the course, even when the market gets rough. It's about being patient and letting the magic of compounding do its work. In the end, investing is a lot like running a marathon. It demands discipline, persistence, and patience. And just like a marathon, the reward isn't just about reaching the finish line, it's about the journey itself. Remember, investing is a marathon, not a sprint. So that's how you start building wealth through investing. We've taken a thorough journey together, embarking on the path of understanding the fundamental principles of investing. It all begins with grasping the basics, like knowing your assets and liabilities and understanding the power of compound interest. We then navigated towards establishing clear and realistic investment goals. Whether it's saving for retirement, buying a house, or funding a college education, having a target helps steer your investment decisions. Next, we crafted an investment strategy. A blueprint that guides your investment decisions based on your risk tolerance, time horizon, and financial goals. We also explored various investment platforms, highlighting the importance of choosing one that suits your needs and preferences. Lastly, we underscored the value of regular investment and patience. Remember, wealth building is a marathon, not a sprint. And there you have it, your guide to start your investing journey in 2024. Don't forget to subscribe to Digital Wealth Link for more investing tips. Thank you for watching.